Hello, everyone. Good morning or good afternoon, depending on where you are, and welcome to this online session on Fundraising 102, which is part of our content platform called The Core. My name is Thomas. I'm the head of startup and investor communities at Hello, and I'll be moderating this discussion today. So if we have a Fundraising 102, it's because we previously had a Fundraising 101 session focusing on how to approach VCs, how to convince them to invest in your deep tech startup. You can still access all the key findings of that session on our website on the deep tech resources section. For today's discussion, we'll be focusing on valuation and share split, cap tables, everything you need to know when raising your first round as an early stage deep tech ventures. Before we start the discussion and introduce our panelists today, I want to remind you that you can react on the chat on the right panel of your screen. You can also start by saying hello and saying where you're coming from. You also have a question tab where you can ask all of your questions and you can upvote the questions from the fellow participants. We'll keep a 15-minute time slot at the end of the discussion for Q&A, so I'll be asking all the questions. So make sure that you ask your questions in this tab and not on the chat. Okay, that's it for all the technical things. Our first panelist today is Laurie Menoud. Laurie has a background in biotechnology and in the chemical industry. She's originally from France, but has been working in the US for the past 8 years. First helping spinning out ventures at SRI International, then in the CVC of BASF, and she's now one of the founding partner at One Ventures. Laurie, thank you very much for being with us. Can you tell us a bit more about yourself and about One Ventures?
Yeah, thank you, Thomas. Really excited to be here. So quickly about One Ventures, it's a venture capital firm based in San Francisco and founded by one of the co-founders of Google X. We invest in deep tech companies that have disruptive unit economics and that are going to help humanity become a net positive to nature. We've made 22 investments so far out of our first fund of $150 million. And we are currently raising a second fund, $300 million, to continue supporting companies in the deep tech sector and climate tech sustainability. Excited to be here and talking about valuations.
Thank you very much, Laurie. Our second panelist today is a second VC. So Craig Douglas, you also have a scientific background and you've been working for 13 years in the energy transition sector, with the last 10 years as an investor, first at SET Ventures and now at World Fund, one of the largest European climate tech funds, where you're also one of the funding partners. So really nice to have you for this discussion, Craig. Same thing, can you tell us a bit more about you and about World Fund?
Thanks, Thomas. Very warm introduction. World Fund, we're a 350 million climate tech fund. So every company that we invest in has to have the potential to save at least 100 megatons of CO2. So that's kind of our bar. So every company we invest in has to have a huge climate savings potential. That means that we invest both in deep tech companies and in business model innovations as well. We're really looking at how do you scale up existing technologies and then what are the new technologies required to stay within 1.5 degrees. We invest from seed to Series B, typically 1 to 8 million ticket sizes, and typically we invest in European technologies. So that's the World Fund. Yeah, well, my background you already mentioned, 10 years at SET Ventures, several years energy consultancy out of London, technical background in physics and chemistry. So I'm not afraid of tech.
Great. I think no one is here. Thank you very much, Craig. And last but not least, so our third speaker today is from the startup side. So Robert Brüll is the CEO and co-founder of FibreCoat. Robert, you have a PhD in mechanical engineering from Aachen University, where you developed new type of high-performance fiber material and where you spinned out the company. And I think you recently closed the first financing round of $3 million. So thank you very much for being with us today to share your experience. And yes, can you tell us a bit more about yourself and FibreCoat?
Sure, thanks for having me. Yeah, so as you mentioned, we are a spin-off of Aachen University, and our mission is to make high-performance materials affordable for mass markets so that many people and also our environment can profit from the properties of those materials. Our first product is a metal fiber that is used to produce textiles, composites, plastic parts in the areas of shielding for batteries in EVs or hospital rooms and many more heating, shielding, design applications out there. So we try to come up, well, no, we did come up with the base material that can change many applications out there. And yeah, as you mentioned, I was working in the university during my PhD when we had this idea in our group and when we developed this into a startup. And just in October, we closed our Series A round where we started to scale our production. So now we're building out more capacity. And in this Series A round, I learned a lot during the fundraising, and also because we have investors from both sides of the lake, so we have European investors and US investors. I hope I can share some insights on the differences between the two ecosystems. And I'm not afraid of tech either.
That's great. Thank you very much, and I'm sure you're going to share some really interesting insights about your own journey. So let's deep dive into what's interesting today. So how to calculate the first valuation in deep tech. So when you're raising your first rounds, is there any specific model that funders can use? Are you expecting first valuation to come from funders? So maybe Craig, how do you process all that? How do you calculate the first valuation?
Sure. The first valuation is probably the most difficult one to get right, I think, and the one that you can screw yourself with the most when you're looking at spinning out your company or looking for your first investment round. When I look at companies, as a VC, I always look at what the exit is going to be. I look at the end conclusion. So, what is the potential for your product in the market? Looking at the final position of where you're going to be, what is the potential value of your business, and tend to work backwards from there. So, looking at what are the key milestones going to be along the way for your company, whether it's technical or commercial, because until you have kind of commercial proof points, until you have that, that first commercial contract, it's very difficult to create a valuation for the company based on metrics. You have to look at what the technology's potential is, not, what the physical numbers are of the company. So when I look at it, I look at companies, where you are today, how much money you're raising, and where is that going to take you to? Because the next round, you need to basically show that you're going to have enough traction for the next round. And the next round is probably easier to price than your initial one. So you've got to make sure that your pricing today is not going to screw your pricing of tomorrow. That's one thing. And the other one is, what is your total market potential? That's the easiest way for me to kind of say, is this large enough? Can I actually make a large enough return? As a VC, we want to be able to make our fund back. We need to make a 10x on our investments. So we look at, is the potential there for this company? Is the market there for this company? And work backwards from that from a valuation perspective. What I will say, one last comment is, anyone who shows me a discounted cash flow at a seed stage deep tech company, I just wouldn't even touch. So I've seen it mainly actually from investment bankers rather than founders. But basically, don't do a discounted cash flow. It means nothing. That's my 10 cents worth. Okay,
thank you, Craig. Laurie, what's your process? Is it similar?
Yeah, and I tend to really agree with what Craig said. Please, no DCF, no discounted cash flows. It makes no sense. And to be honest, at an early stage, valuation is more of an art than a science. And the reason for that is that typically there is no history of financial with the company. Typically, you don't have revenue yet. There are a bunch of hypotheses around the business model, around the pricing strategy. So it's almost impossible to come up with a kind of exact valuation for the company. So typically the approach we take, first it's looking at comparables. So comparables on the market, companies that are at the same stage that you are, in the same sector, going after the same market. I look typically at those comparables and I do an average, and depending on the strengths of your team, of your tech, of the exit opportunity, of the size of the market, I apply either a discount or a premium on this average valuation that is on the market. So that's one way to look at it. The other way to think about the dilution rule for each round. So typically a company is going to be diluted anywhere between 20 to 30% each time you raise new funding. So at the seed round, even pre-seed, seed, Series A, think about this kind of 20, 30% rule. And based on that, you can define a range of valuation that is probably going to make sense for you. For example, if you raise $3 million, it means that roughly the lowest valuation you are going to think about is probably $10 million post-money valuation. And something that is going to look pretty good is something around $15 million post-money valuation. So just keep that in mind. But similar to what Greg said, it's complicated to set a valuation at the pre-seed or seed stage.
Okay, thank you. And so one thing, wondering aussi, and I'll ask you, Robert, to tell us more about your journey. Did you come up with your own valuation when talking to the first VCs? And how different was it from the valuation that you agree on, like when you finalized the round?
Okay, it was a completely roller coaster. So from the number that we started with to the number that we ended up with, it all changed in the course. And that's also when we learned, or I learned, that you can come up with any number. So there's a way to calculate the lowest and the highest valuation out there. So it's, especially in the seed stage, and for us it was also the first round, it's almost impossible to agree on a way to calculate. So what we found is that we talked to many people. We defined what we need to reach the next milestone. So basically, we put down what are the milestones, what are the targets, what are the steps that this money should bring us to achieve. And then when we knew how much money we need, we then looked at how much are we willing to give, and we had the range that Laurie mentioned. And then we reached out and actually we tried to get as much input from investors as possible. So to see what is our market worth, talking to as many people and as many experts, investors as are out there, which then gave us a pretty decent range of what is reasonable and where to negotiate. So this was our process. And what we learned in the way is that it's close to what Craig said in the beginning, you have to think about your equity story. Because usually this first financing round is only the first step of more financing rounds down the road, and you will have more and more milestones to achieve. And what investors, and I think VCs, want to see is what is the way that you're planning to go, and how does the exit look for the VC? So what's the potential in order to put a price tag on the first round? So really defining those information that Craig and Laurie just mentioned, to make their life easy to come up with a number, is, I think, the best way to move forward with negotiations.
Okay, and so you have VCs, so you did negotiate the end valuation.
Yeah,
there's room for negotiation.
There is room, but it's not like haggling in the end. So from our side, it was basically understanding why do we need that amount of money, and what is the impact on the equity story. So these were the two main arguments that we had in those negotiations. Okay,
thank you. And are there any other factors that are impacting valuations? For now, and we look from both sides of the Atlantic, in the US and in Europe, it seems that valuations are much higher in the US currently. Laurie, so you're based in the US. Is that something that you see? And what's the impact as well on the on the long term?
Yeah, definitely. I see that the valuations typically in the US are much higher compared to Europe, as an example. What is impacting those valuations? So, of course, the market conditions are also going to impact the valuation. Typically, in the US, you have a very well-developed and mature VC industry. And at the moment, there is lots of capital available on the market. And because you have lots of capital, similar to other type of markets, you have an imbalance in the supply and demand. So this is creating an increase in valuation. It's creating also more competitivity among investors. And when you have competitive deals, it's just increasing the valuation. So if you receive one term sheet, it's fine. But if you receive multiple term sheets and a lead investor really wants to win the deal, typically this VC will have to bid higher. And so you end up with valuations that are, again, driving up. And I will say maybe a difference here in the US is the way entrepreneurs sell the vision of their company, especially in the Silicon Valley. People are really well trained around pitching ideas to investors. And if you manage to pitch a big vision for the company, a big opportunity, and potentially a big exit, based on what we discussed earlier, this is something that is going to, again, to drive the valuation up. And so because of all of those conditions, in the US, the valuations are much higher at the moment.
And is that true for then for US startups, or do you think that US investors are also willing to put higher valuation in European startups when they invest in European startups?
I think they're a bit less valuation sensitive. I think there is still a tendency where the valuations are lower in Europe. Again, because I think, and being from France originally, in France, for example, and this is changing and improving, but we have a tendency to undersell the vision of companies, while in the US, people have a tendency to oversell. And so when you have an imbalance like that, it just keeps the valuation at a lower price.
Okay, thank you. Craig, do you agree with that? You feel, I guess, you invest mostly or exclusively in Europe?
I mean, we do. I mean, in terms of which companies we see, the majority European, although a few are US incorporated, just from a legacy perspective. But looking at the differences, the market in the US, as you say, Laurie, is already it's more mature. There's more frothy. There's more cash around. Although I have to say, in Europe, it's getting similar, but the selling nature, I think, is really fundamentally different. Particularly in deep tech in Europe, founders are happy to tell you all of the problems of their companies and all of the challenges, and not oversell. Whereas you'd normally find that out in due diligence in a US company. You only get to see the dirty laundry halfway through. Whereas European startups tend to put it on to do your pitch meeting, which seems slightly different. But we see it, US investors coming into Europe, they're much less price sensitive. They're far more willing to put something on the table quickly and put it in at a higher valuation than you would typically expect in Europe. The other thing is European investors are more conservative. So they want to see, they're less driven by the super returns of a company and are more likely to see companies making a 4 to 5x rather than a 20x. It's history in Europe where the failure rate is lower, but the super success rate is also lower.
Okay, thank you, Greg. I think, Robert, so you raised from investors from both North America and Europe, and you're originally from Europe. So do you agree with the description of the market and the mindset of investors in both US and Europe that Laurie and Craig described? And can you tell us a bit like how it was for you?
Yeah, I agree. And I agree also on the startup side that they mentioned, because we did exactly that error. We started with a we were very honest and open, and explained also the errors and problems of our startup. And to be fair, the investors in Europe also tended to ask more in technology and more into the details of our company. While in the US, people wanted to hear about visions and potentials and basically how are we going to change the world. So the pitch is completely different. We learned that very early when we saw the reactions of the investors, and just tried to go with a more like overview and vision type of pitch in the beginning. And this also changes the overall discussion because the details come later in the US, while the vision plays a smaller role in Europe. And I think this also gives the mindset of overselling in the US and underselling in Europe, and this should also lead to the different valuations. However, to be honest, we had comparable valuations in Europe and Germany. So speaking about our personal journey, it was very much comparable between the two continents. Just the interaction with the investors was very different.
And adapting, I guess, so you pitch your deck to US investors and to European investors to cater more to their needs.
Exactly. So since we learned more about the US, we start our pitch with a vision and a very broad market overview, and then go down into the details. While in Europe, we used to start with why is our technology so cool and how it's going to change the world. So it's the other way around. And we figured that these different styles also led to different reactions from investors. The US like more the vision, and Europe more the details.
Is in later on, like in negotiating, for instance, on valuation, or like, did you see like more room from US investors, from European investors? Was it the same, or it really depends on the person or the fund?
So I'm sure that every person and fund is different, but overall, talking about money and valuation was comparably easy going in the US. It was really a very direct and clear exchange. In Europe, it took more work to get to that point where it was an open exchange. So I think what is mentioned, that the pocket is a bit looser in the US, it really seemed that way. Although we still had to talk about details and then to explain the exit scenarios. So it's not like they just give you money. You still have to work for it.
Okay, thank you very much, Robert. There's another question that I wanted to like, another topic that I wanted to tackle is the impact of early decisions and particularly of business angels investments. And so for pre-valuation, we could have you can have convertible notes from business angels, and so how is the impact of these convertible notes later down the road when you start raising your fund and when you get your valuations? Maybe Laurie, can you quickly explain how angel works compared to VCs, and what you need to be aware of, and what are the impacts on the long run?
Yeah, so typically angel investors are high net worth individuals, people who have had successful careers, they have money available, and they want to engage in the entrepreneurial community and help funders. But typically they don't have lots of resources when they make investments. So they, most of the time, never invest through price rounds. They typically invest either through convertible notes that are typically loans, or through SAFE that are simple agreements for future equity. Those documents are just a few pages, very easy to execute. So it's also good for you, the company, because you're not going to spend too much time negotiating a bunch of legal terms. At the same time, it's really important for you to understand the nuances between those different documents, because you have the convertible notes, sometimes you have interest rates related to that. With the SAFE, you can have pre-money and post-money type of SAFE. So I would really recommend at that stage just to sit down, draft a cap table today, and a cap table at the next price round, a seed or Series A, whatever it is, where you have kind of you set up a price and you understand how the conversion is going to look like and how much dilution you are going to get from those convertible notes or SAFE. I'd also recommend, although those documents are short, to make sure that what you are signing is standard, is an industry standard. And a way to check for that is to look at the European VC Association in Europe, or NVCA's North American VC Association, because they have template documents on their website, and you can make sure that what you are signing is similar to the template documents. And for SAFE, you can look at Y Combinator, which is a US accelerator, and Y Combinator defined the SAFE documents. And again, just making sure there are no tricky terms inserted in those documents, because I've seen cases like that where you had, for example, the notes converting after the new option pool expansion at the next round. And because of that, the dilution for the founders was pretty big for just a few notes they had signed with angel investors. So just make sure that everything is standard when you work with angel investors.
Thank you, Laurie. Craig, would you have anything to add on that?
Yeah, so this is really market dependent, right? So in the UK, there's a huge tax incentive programs with EIS. So you don't get people putting in loans. You get people basically just putting in equity. And for them, it's free, right? They would have been paying this to the taxman anyway, so they're not price sensitive. So you need to be quite careful and quite aware that this is regionally really quite different. What I can see, and if a high net worth or an angel investor has priced the previous round, they're often less price sensitive. And you need to be really careful in taking that money that you're not causing a huge amount of problems for later. So I've seen companies go out with nothing at a 20 million pre-money or a 20 million valuation of the last round, where someone's thrown in 200K. And basically it means nothing. And the first thing you do is say, well, your previous round was way too high. I can offer you half that. And that is often quite demoralizing for the founder, or can cause quite difficult situations where your investors walk away saying, you're already too expensive, goodbye. So be very aware that if you're expecting to get VCs in, angel investors do not have the same financial considerations that a VC does. Often angels are happy with a much lower multiple than a VC is. It can also be very advantageous and also very positive, particularly if you've got people from a specific industry or with specific expertise to get in. It's a good sign, but be very, very careful. And I'd reiterate what Laurie said is make this simple. Do not make this overly complicated. If there's anything non-standard in there, either the new investor would basically just rip it up and tell you to change it, or you're going to cause yourselves all sorts of untold problems in the future.
Thank you. Really good word of advice. I think so, Robert. If I'm correct, you didn't raise any you didn't get any previous equity from angels, but I wanted to talk to you about something else, about the specific case of university spin-out, because in deep tech, so what we see at Hello Tomorrow is roughly like 1/3 of deep tech startups in our community are university spin-outs. And there are different ways to work, like different universities work in different ways. Sometimes it's just like non-binding agreements, sometimes it's IP licensing, sometimes they get equity. So FibreCoat is a spin-off from Aachen University. Can you tell us a bit what type of agreement you have with them and how did you get there?
Okay, so in our case, it's fairly straightforward because we just bought the IP out of the university. So we had a lump sum payment and then another success fee down the road, and we own any IP fully. On top of that, for any research and equipment or work that we do with the university still, we pay. So we actually pay for every hour of laboratory that we have there, which is in our case good because it gives us a very high flexibility. We are it's easy to explain to investors, and we also had the funds to pay for those things. However, it was a very long process, and it's also the most important thing is to start this process of negotiating with the university as early as you can, because in our case, I think the overall talks were for 1 year or longer, which is not solely the fault of university, but many stakeholders involved. It's a professor that you might have worked with, it's external partners, it's some regional funding agencies that might have a stake in it, and to get all of those on board and to align into one concrete agreement can take a long time. And in that time, what you mentioned, we talked about equity, we talked about licensing, we talked about just paying the money, we talked about a lot of different ways to structure this. And we found that the university usually thinks only mainly in the legal aspects that they have to stay in, and anything else is open for negotiation. But you have to make it clear, you have to show them, you have to come up with the methods to give a prices or licensing to those deals. And what I think is you have to stay confident and you have to know what you can do. The more freedom you get from the university, the better. But in the end, even a licensing deal can be okay if it doesn't kill a company. So when negotiating with universities, I think the best way is to explain to them what's going to happen with the technology, what's going to happen with the startup, and what is feasible for the startup. Because if they ask for 50% equity or 10% revenue fees, the startup will just die and they won't get anything. So getting to those points is key.
Okay, thank you. And so was it like you already had all that in mind before going into negotiation with them? Like you knew that you wanted, like you said, as much freedom as possible, and you had the financial means, or like were you like open at the beginning and seeing like what could get out of the discussions?
Yeah. We started very early when we didn't have any revenue or funding. So at that point, we were talking about licensing. And then when we had the chance to switch to a more flexible way, we took that because it's very evident very early on when you talk to investors and partners. If you don't own the IP or the university has some kind of a chance to take it away from you again, all discussions get harder. And when we saw that, we figured out that we need to have a deal where the university has lowest possible involvement in the startup in the end.
Okay, thank you, Robert. Laurie, do you agree with that? Because you worked for a few years spinning out ventures. You're now a VC from kind of the other sides. So do you agree with the fact that being as independent from the university as possible is easier down the road?
I definitely agree, yes. And I think, no, agree with everything Robert said. Really important to take the time to negotiate well with the university, because typically universities, and that's also the case for national labs and for venture studios, the most concerned things are going to ask you are equity and revenue on royalties. When you look at equity, most of the time they are going to ask for too much equity. And Robert mentioned 50% equity in your company. I've seen those cases. And the problem is that later on, when you are going to raise funding, investors are not going to like that. Because if the university has 50% equity in your company, it means that the founders plus all of the employees will have only and maximum 50% of the company. And later on, because you are going to be diluted by the new round and the funding you are going to get from investors, your ownership in the company as a founder is going to end up pretty low. And you may end up in situation at a Series B stage where you own less than 10% of your company. And investors don't like that because they don't see the founders having skin in the game anymore, having incentive to make the company worth more. So it's not a great situation. So I will say try to negotiate, I was in the maximum something like 25% in equity in your company, kind of grand maximum. And then related to royalties, similarly here, universities or national hubs have a tendency to ask for too much royalties. The problem with royalties is that it's going to hit your cash flow and hit your runway. And because of that, you are going to need to raise sooner and raise more money, which is again going to dilute your ownership in the company. So same here, make sure that the royalties are not too crazy high. I would usually negotiate anything lower than 5% royalties on your sale. Make sure that there is very little or no minimum annual royalties that are asked by the university. And if you can add a cap on the royalties that the university can take every year. For example, you can have a cap of 50 or 100K just to make sure that it's not going to be a big hit for your revenue and your company.
Thank you, Laurie. That's very clear. Maybe Craig, so quickly, do you agree with that? And so if you agree, that's one question is it might be too late for some of the startups who already negotiated terms with their university. Is there a way to fix early mistakes or like unfair agreements?
Yeah, so I completely agree with Laurie there in terms of what you can do. You can also basically make sure your royalties only kick in once you hit a certain revenue threshold. That's the other way to do it. Basically, it doesn't hit you until you're at 10 million in revenue. That's the other way to make sure that you're not going to screw yourself until you can raise your larger rounds in the future, or until you get closer to profitability. You can fix things. Unfortunately, I have had to do this before. Typically, what it ends up doing is you just put in money at a low valuation and you create a massive ESOP pool, a massive option pool. So we've done it where we've basically put in a low ball value valuation because typically universities, particularly in Europe, don't follow on their investments. It's basically this is your percentage and that's it forever. You put it in a low valuation and you create a 20 or 30%, 40% even ESOP pool. And you just basically hand that over to the founders. So you can fix it. And particularly that can happen when the universities can't play, which is typical in Europe. It's more difficult in the US where typically university funds can follow on investments. Or not typically, but they can. So you can fix it, but it's a problem that you don't want to have to fix. You have to have an investor who understands that that's possible and willing to go through the pain often of getting the universities on board with taking that dilution.
Thank you. And so you said that university also behave differently between Europe and the US in terms of following up front. Do you think they also behave differently in terms of negotiating the agreements with their spin-outs? Or is it really on by case by university?
It's really university by university, and some of them are a real pain in the ass, and some of them are really easy. So some of them are really used to this. This is the same with technical institutions as well. Some of them get greedy, some of them don't. Often they start with a ridiculously high bar, and it's up to the entrepreneur to figure out whether they can get that back to something more sensible. Honestly, I find that really frustrating because I think it massively limits what you can do. It should just be, the universities that are good at this, they basically say, okay, anything you want to do, here's the equity proportion that I want. Go and do what you want with this technology. Like that's far simpler, far cleaner, and doesn't end up with huge problems in the future. But that's very, like even in the Netherlands, let's see with Robert, because I'm based here as well. Between the different universities and different research institutions, there is a very different approach to this. So even the research institutions where they think it's their technology, where the technology is being built in-house, they tried to spin it out and they gave the founders 10%. I mean, it's just never going to fly. They're never going to be able to raise money with that.
Okay, and just so you said that, so it makes it difficult when you have a bad agreement. Did you ever walk away from a deal because of that? Because the university owned too much shares of the company,
Yes.
for instance?
Yes.
Okay. And Laurie, is the same for you?
Yes, same here.
Okay, so that's really, really important. Maybe just so we talked about so early investors, business angels, university. So who else should startups have in their cap tables? Do you think it's a good way to incentivize key employees with shares? And if so, how much? How many employees should you give shares to? Maybe Laurie, we can start with you.
Yes, I'll give the Silicon Valley view here, and I know it's different for some other parts of the US, in Europe, even in Canada. To me, equity should be for all employees because I think it's the best compensation tool for recruiting, motivating, and retaining employees at a startup company. With a vesting period, for example, so when you give equity to employees, you typically have, at least here in the US, a 4 years vesting period. Just this mechanism, it's a way to incentivize people to stick with the company for at least 4 years. It's also a way to make sure that people and everybody in the company have skin in the game. Just motivating them to make the company and therefore their equity worth 10x more. So to me, yeah, I think employees being on the cap table is something extremely important. And it's I know that the practices are sometimes different. For example, in France, people are not that used to having stocks in company. So it takes a bit of education. But once people realize what their equity and the shares they have in the company could be worth at exit, then they get really excited about it.
Thank you. Maybe so, Craig, because the situation is so different in between the US and Europe. I think even like within Europe, between countries, the situation, like cultural situation, is different also. Can you tell us what's your view on that?
Yeah, this is entirely country dependent and individual dependent sometimes, and also tax system dependent. So if you're in Germany, ESOP is not very valuable. Most employees just go, oh, okay. No, you've got to think about what is actually incentivizing your employees. What is what is driving them to be there? What is, for us, it's easy. It's in some ways it's easier because most of all of our investments are climate focused. The people who are there want to make a difference from climate. Money is often secondary. But if you look at it in terms of which markets, which companies, I'd say across the board, good C-level people should always be incentivized with options. Always, because you want to make sure they stick around, as Laurie said, so a decent vesting scheme, and you want them to be incentivized the same way the shareholders are. However, for a general employee, it's really dependent. In the UK, this is normal. Every employee wants options. In Germany, it's not. In the Netherlands, it depends. And you can really have problems trying to do this practically. Because in Germany, for example, if it's not done well, then employees are on the hook for any tax increases. It's every option you deliver is taxed as if it was your salary. So you're taxed on any benefits you give your employees at the price per share you issue them at. So it gets crazily difficult or crazily complicated and potentially really expensive. And this is also the same true in the Netherlands sometimes, depending on how it's structured here. I know one company or one founder that's ended up being listed, went all the way through it, hasn't sold any of his shares. He just had to sell 7 million of his shares to pay the tax man. He doesn't have any cash in the bank. He had to sell 7 million of his shares because they went up so much in value. So if you think about it and you look at it, the country's specific requirements on options and tax plays a big part in that. And understanding the underlying motivations of the employees is also really important. But I would say I love options as a way of incentivizing people, but it is culturally very different. And always, I would say C-level should be incentivized with options.
Okay, and so you said like at C-level, so usually what's the max number of people, or is there a max number of people that you should incentivize, and how much you should give them? Just being like reasonable to incentivize them enough, but also not to give like too many shares of the company.
Well, typically we like to have at least a 10% unallocated ESOP pool when we join, and that's purely for focusing on C-level employees. So, you know, if you have 5 employees, 10 employees at that sort of high level, you're talking, it varies from 0.5% to 3% potentially, but also that really depends on the company's stage. So, and the roles that these people are likely to have. I think Laurie might have a stronger opinion on this than me.
Yeah, again, quickly, different perspective from the US, but typically, I'd say for funders, in terms of equity range, we are talking about anywhere between 5 to 80% of the company. For key contributors that I would categorize as people who have executive skills, so kind of VP level, that have a life mission for what the company is doing, I would consider anything between 0.1% to 5% equity in the company. And then for the rest of the employees, it's typically lower than 0.1%.
Okay, thank you. And so Robert, what can you share with us on what did you do, and do you agree with the fact that it depends also on employees and on the country?
Yes, but there's always a solution, I think. So I agree that it's hard, especially in Germany, to make a good ESOP pool for employees, but it is possible. There are methods like virtual ESOPs or other ways to structure it. And in my opinion, I would go with Laurie's way, and that's also what we do in FibreCoat. We offer every employee options, and then there's a difference in amounts depending on C-level or their contribution. So we do that too. We're actually just rolling out these up this month, so it's a fairly new thing. What I found over the years is that motivating through rewards or punishment isn't really working. Ownership is much stronger, especially if it's something that they work on every day. And also the projects that they do, they know that this will move forward the company. This is something that gives more motivation from my point of view. That's why we basically stopped the bonus program and starting now with the ESOP approach. Furthermore, what is very important, and I think this hasn't been mentioned yet, is it's also the best way to pay very expensive employees. So as a startup, when you have low financials and you don't have enough money to pay 150K for the key sales person or the key financial support, offering shares is sometimes a better way. It doesn't have to be like 50 or 10% or a big number, but sometimes this can really lower the salary you have to pay to make that person happy and also to bind them to the company. So I agree on that part too.
Okay, thank you very much. Maybe so we have like a bit less than 10 minutes left. So I wanted to take some questions from the audience. So I see that Craig, you answered a few of them already. Maybe the one for Craig and Laurie. So are you using decision tree methodologies at the seed stage to review the limited number of strategic stages of chances of success? So Craig, you already answered that. Laurie, do you have anything to add on what you're doing?
Yeah, I don't know exactly what they mean by decision tree methodologies, but when we make an investment, so we have a list of criteria where we make sure that the company is going to fit our key criteria and make sure there are no red flags. We also look at different scenarios in terms of growth of the company and exit opportunity to understand what is the potential of the company. So maybe that's what they mean by decision trees. But yeah, scenario is definitely something we look at. Kind of the worst case scenario if the company target those type of revenues, medium case scenario, and best case scenario.
Okay, thank you. One question from Keenan. So could you share some example of metrics used to justify valuation? So we talked about it at the earliest. Can you just recap really quickly what you look at for like when calculating valuation? Yeah, sorry, Laurie, you can go on.
Okay, we quick comment side. I look at comparables, so companies that are similar to you on the market, and then I add kind of a premium or discount on your valuation depending on the strength of your company. And I'll also keep in mind the 20%, 30% dilution rule to make sure you are not going to be diluted too much with this new financing.
Craig, do you have anything else to add?
I think I answered already, but basically when you look at it, you look at what the total, not just what the, well, I said total addressable market. What I actually mean is what proportion of the market is actually going to be addressable for you. So your sum, not your, sorry, your SAM, not your total addressable market, and work backwards from there, because that shows you what your end potential is. Then look at how many rounds you're going to have to do to potentially get there. And that tells you what the maximum valuation you could really expect, particularly given that every VC that looks at you will want to get a 10x. So make sure, as a founder, I would say if you're wanting to get a nice valuation, make sure your market size is big enough from the start, because if you're going into a niche that's too small, then you're never going to get a good valuation. Even if you become the market winner, you're only going to be worth tens of millions, not hundreds of millions or billions. And there, you're not going to get a VC. You're better sticking with angel or private investors.
Okay, thank you. So the question from Stephen about H2020 Horizon Europe funded startups. So either grant money or equity money, and does that have an influence on you? So Craig, you answered. You said you would be worried about companies with lots of these. Can you maybe elaborate on that? Why would you be worried about that?
Because these are specific programs that have very specific goals. So if you've applied for lots of them and you've got lots of them, they're funding multiple parts of your R&D program that are probably unrelated. That's the answer. So what you've then built is a company that's good at winning grants, not a company that's good at getting customers. So it's fine when you're going for grants which have a very specific purpose that match your R&D pipeline. But if I see a company that has 3, 4, 5 of these in there, I will be asking them in due diligence, how did this match your R&D? How did this match your R&D pipeline on your R&D development program? Because if it doesn't, then you've just been getting money from grants because you haven't been able to get investment. And that is not a good sign. And I can think of a few, by the way. So it's not a good sign in that case. Yeah.
Okay, that's very clear. But if it's like also like equity from the EU, for instance, or all the European funds, that's not like a warning sign for you, or is that a positive sign, or how do you view that?
Not positive or negative, pretty neutral. Depends on the sector. Some of them, they're so sector specific that there's basically no one else there to do it. The same way we treat a regional or national fund. Like, it's not necessarily positive, it's not necessarily negative. It can be problematic when they ask for too much money, but the EU funds tend, the H2020 programs haven't been too bad at that.
Okay, thank you. And Laurie, your own perspective from the US?
No, I agree with Craig. I mean, if the company is getting a bunch of different grants, those grants have to be relevant with the milestones the company is trying to hit. But if that's the case, actually, I like the fact that companies can get grants because it's non-dilutive funding, which means, again, you can preserve your ownership in the company and get this free money to get to advance your technology and get it closer to product. So it, again, depends on the type of grants.
And
okay, thank you.
Maybe just one comment here. The new program from the EU for first-of-a-kind projects, if you're doing it or you're looking for something which has significant amounts of capital for your technology, go for the grant program, because you can get big chunks of money, and investors don't like investing in hardware first-of-a-kind plants. But the new EU funding program will let you, and I know of a few people who have already got tens of millions in there, which their investors didn't have to put in equity. So be aware that those programs are there. I'm much more excited about them than I would be about a grant, just also to be clear, because you've massively de-risked the capital requirements of the company.
Okay, thank you. Maybe quickly, Robert, because I saw you agreeing when Craig and Laurie were talking about grants. Did you get any?
Yeah, so actually we raised 3 million in grants also over the last 2 years, and there are grants out there that fit perfectly to your startup. So I wouldn't say that too many grants or different grants is bad, but rather look for the right grants. So we got money to invest into our plans, we got money to develop our product, we got money to travel to the US to talk to investors. So there are good grants. I agree that it shouldn't be like you shouldn't found a research institute, but in Germany and Europe, we have so many different approaches: regional, international, European. There's so much you can do, and if you mix them and match them to your needs, I think that's a great way to go ahead.
Okay, thank you. We have just 1 minute left. I wanted just to add, and probably we will need more time for that question, but how do you see the current events in Ukraine affecting so more than just the climate tech funding landscape, but the funding and the VC landscape? Craig, maybe just quickly, do you have an opinion on that?
People are being a little more cautious in terms of the capital they're deploying. So at the moment, it's not really filtering down into the VC world, but I've seen it's already significantly changing the angel landscape. So, as part of the World Fund, we have 150 private investors into our fund, family offices, individuals, entrepreneurs. And some of the feedback we've had already is people are being more cautious about deploying their capital, and they're more in a wait and see mode. But those are individual investors. The larger VCs at the moment, there's not been a significant adjustment that I've seen present thus far.
Okay, thank you. And Laurie, maybe from the US?
No big adjustments so far, I would say, except for specific cases, for example, where the company is going after natural gas markets. And so there we see a bit of an impact in the valuation of the company. It's just starting, but overall, lots of capital on the market still with VC, especially because a bunch of funds closed last year. So people have capital available to deploy to early stage companies.
Okay, thank you very much, Laurie. And so we are at a bit more than 1 hour, and this is the end of the discussion. So thank you very much for this interesting discussion, Laurie, Craig, and Robert. I hope this was helpful to you in the audience. It's a lot of good insights. So the session has been recorded, so you will find the link in your email right after the session, and we'll also make like a written summary of all the key findings that will be available in our newsletter, The Core, where you can register on our website and also on our blog. So thank you very much for joining us today, and enjoy the rest of your day, and keep posted for our next session on Fundraising 103. Goodbye, everyone.
Goodbye. Thank you.
Goodbye and thanks.